Good afternoon, everyone. I would like to welcome you to our presentation about primary financial statements project. The IASB issued the exposure draft general presentation and disclosures in December last year, and IASB issued the equivalent in January 2020. My name is Helena Simkova and I am from IASB, but we also have Tarca and Aida Vatreniak from IASB doing the presentation and answering your question, and James Barton and Chris Beach from IASB. I would like to mention that the session is being recorded, and we will put the slides and hopefully, if the technology allows, the whole recording on IASB website, probably soon, maybe later this week. Anne, I will hand over to you so we can start the presentation.
Thanks, Helena. Good morning or good afternoon, everybody. It's great to be here with you. I'm very pleased to speak to you about the Primary Financial Statements project. So firstly, some housekeeping. Slide 2 of the pack. The views expressed today are those of myself and Aida. They aren't the views of the IASB or the IFRS Foundation or indeed the AASB. We're speaking about the Primary Financial Statements project. You can find all the relevant materials on the website, and the link is shown in slide 2. What we'd like to do today is to hear from you. So we'd like to have your questions and comments typed into the text box. So on your screen, you can see a text box. So this is not the chat line. We're not going to use the chat line, but we're going to use the Q&A text box. So if you could please type in questions and comments as we go. What we'll do today is pause after each break in the materials and have some questions and some discussions. We're really interested to hear from you. So what we will do is Helena will call on people, nominate questions for myself or Aida to answer, and we will unmute the microphone of the person asking the questions. So that person will be able to talk to us as well. So let's get going. Slide 3, Primary Financial Statements project. This project has come out of our initiative around better communications. So there's a very clear objective of this project, and it's about improving how information is communicated in financial statements. So this represents a continuation of the work that we were doing, say, back in 2013, where we're looking at better communications. And then we took better communications as a theme following the last agenda consultation. So the Primary Financial Statements project, we released the ED in December of last year. What we're going to see in this slide deck is we're going to touch on the proposals in the ED in 4 areas. So there are 3 main areas, and then in addition, the cash flow statement. So 3 main areas. The first area that I'd like to talk about relates to the subtotals that are being proposed for the statement of profit or loss. So if we go to slide 5 in your pack, you can see that we're trying to identify the issue. What is the problem trying to be solved? The exposure draft is about improving comparability in the statement, mainly in the statement of profit or loss. What we heard from investors and others was that because the way IFRS standards were set up, and IAS 1 had only a requirement for a revenue line and a requirement for a total profit or loss, there was enormous diversity in the subtotals that entities would include. And even if they used the same name for a subtotal, this did not mean that the subtotals themselves were comparable. So there was diversity there. There was also diversity in the way people disclosed things such as the share of profit or loss from associates and joint ventures. There was diversity in where line items would appear. So the aim of this project is to improve the comparability by providing more structure in the statement of profit or loss. Looking at slide 6, the project responds to the feedback we've heard from investors who are asking for more comparability. They've also asked for more granular information and for information to be grouped in ways that are useful for analysis. They've also commented on performance measures, so what we're calling in the ED management performance measures that you might know as non-GAAP earnings or non-GAAP performance measures. So in response to that sort of feedback, the proposals can be grouped into 3 areas, and that's what we'll talk about today. Firstly, about defining subtotals and having additional required subtotals within the statement of profit or loss. Secondly, it's about disaggregating information, so improving the information that investors have by thinking more about aggregation and disaggregation. Thirdly, it's about some required disclosures around management performance measures. So, looking at the first of those, on slide 7, you can see an example of the proposal in relation to subtotals. There are new subtotals and they create categories. So the new subtotal you can see there, operating profit. And above operating profit, this area should represent the main business activity, and that creates a category we're calling operating. If we now go down to the bottom, you can see the third of the subtotals, profit before financing and income tax. By casting that subtotal in there, we've put the line items, the income and expenses that relate to financing, and we've separated them out so that investors can look at the results of operations of an entity without the financing component. As we were working on this, we also discovered that we needed to make a category for investing. So we have now also an investing category, and that's reflecting investments from assets that are largely independent of the main business activity. We also have a subtotal, the one in the middle, operating profit and income and expenses from integral associates and joint ventures. And I'll talk to you in a moment about why the board needed to conclude and propose that particular subtotal. But what you can see on slide 7, we now have an operating category, we have investing, and we have financing. So going to slide 8, what would appear in each of these categories? Up the top in operating, main business activities. We're calling this a default category. This is where you should be able to look and see income and expenses about main business. Things go there because they haven't been picked up in financing or in investing. Going into financing, as I said, that's about separating out the financing income and expenses so that investors can compare companies' performance before the effect of financing decisions. The things that we've specified to go in there, income and expenses on liabilities arising from financing, you'd expect that to be there. Interest income and expenses on other liabilities. Again, you would expect to find that in the financing section. We've also specified that that's where you'd find the unwinding of a discount on pension liabilities. We've also specified cash and cash equivalents into the financing section. And we've done that because for many entities, cash and cash equivalents are a form of financing. Looking now at the investing section, the idea here was to identify assets that generate returns largely independently of other assets. And we aim in this section to capture income and expenses from investments that the investors are looking to analyse separately. We would expect things like fair value changes on investment property and other financial assets, not cash and cash equivalents, but other financial assets. We would expect them to appear in the investing category. Going to slide number 9, I'd like to talk about associates and joint ventures. So you remember in slide 7, we had that subtotal that we're proposing. And this is a compromise. It reflects the different views that we've heard from stakeholders. So on the one hand, there are people that say that the associates and joint ventures are part of main business and they want to include the share of profit in the results. There are others who say that share of associates and joint ventures can't sit within the operating profit because they're after financing and after tax, and they need to be analysed separately. So in order to reach a compromise position, we have decided for integral associates and joint ventures, the share of profit for them to be in the line item directly under operating profit, and then creating a new subtotal that you can see in slide 7. So that's the subtotal, operating profit and income and expenses from integral associates and joint ventures. If the joint associates and joint ventures are being classified as non-integral, then they would appear in the investing category. Turning now to slide 10, we've had to consider how this format would work for financial entities where their main business activity does include interest income and interest expenses. So these line items would appear in the operating category for a financial entity because that's their main business. So the proposals would allow for banks and other entities with that type of activity to include income and expenses that would otherwise be in the financing category. Because of the definition of the financing category, they will appear in operating category. Similarly, something that would fall in investing based on the definition that we've just been looking at, that would go in operating based on the main business activities of the entity. If we turn to slide 11, we can see an example of how that might look. And you can see that the income, interest expense are appearing in the operating category here rather than in financing. And in addition, income and expenses that are related to investments made in the course of the main business activity are also in operating. This presentation also works for entities that have, for example, a manufacturing arm and a financing arm. If the financing component of their business, say they're an automotive manufacturer and they're financing, the financing component is part of main business, well, it'll be up and operating. Right, I'd like to pause now and open for questions. So slide 12 says we're looking for any questions or comments or feedback on the subtotals and the categories that I've just outlined.
Over
to you, Helena.
It's Helena here. I will encourage the people to even if they don't have any questions, to just type their comments through the question and answer tool, because then we would be really keen on getting any feedback on the proposal. While we are waiting for the questions, and I may ask you some of the one of the questions that we heard before, and that was actually the structure or the categories in the financial in the P&L have the same names as the categories in the cash flow. So are they meant to have the same meaning as well?
Thanks, Helena. So we are using the same titles, operating, investing, and financing. But here in the statement of profit and loss, we're looking at the items of income and expense. So we're trying to capture the items of income and expense, which is not what's happening over in the cash flow statement. So the way the cash flow statement has been structured, it's set up in a different way, and it is actually capturing different things within those categories. Now, in a perfect world, we would work also on the cash flow statement, and we would work also on aligning the categories between the two statements. But in order to scope our project for primary financial statements, we're addressing only the statement of profit and loss. So at this stage, the categories do not integrate across the two statements. If our stakeholders are interested in us doing further work on the cash flow statement, it would be really ideal if they could put that commentary into the agenda consultation process that we're beginning in the second half of this year.
Thank you. And we have another question from Martin. So Aida, would you like to answer Martin's questions? And James, could you please unmute Martin? Thank you.
Thanks, Helena, and good morning or good afternoon to everyone. Hi, Martin, are you with us now?
Yes, I am.
Hi, so you had a question about associates and joint ventures, is that right?
Yes, it's around the definition of integral. So if an entity has a material associate, so it's very large in terms of its P&L and its asset base, but it's not really necessarily closely connected to their business activities, is it integral? It's material to their P&L, but it's not, you know, it's sort of different to the rest of their activities.
Understood, and thanks for that. And indeed, we get lots of questions about integral and non-integral. It is a new term. It is a somewhat judgmental area, even though the board has proposed a definition and some indicators to help companies distinguish between them. But in response to your question, so materiality is not really a criteria for integral. So you could have a scenario like you explained where you have material investments in associate that is considered not to be integral because, like you said, it's not really linked, the returns are not really so linked to your business, but it is really just an investment. So that could happen. I mean, it is interesting that we get quite different feedback from users of financial statements on this. On one hand, they would say, I would be very surprised to find companies with material investments in associates that are not classified as integral, because then I would be wondering, why are they spending their money on this and, you know, bothering with, you know, having an associate if this is really not part of their future, part of their strategy. But then on the other hand, others, I think, recognize that business strategies change and it's quite possible for this to happen. So I hope this answers your questions, Martin.
It does, thank you.
So before we move off that, Aida, just a question. Did the board give any consideration to whether or not joint ventures should almost be a rebuttable presumption that they are integral, given that you have joint control, and so you would expect that you are closely interlinked with that entity?
Thanks, Chris. And indeed, this was a consideration, and at one point during discussions with the board, there was a view taken that maybe rather than integral or non-integral, we just split along associate JV line, because, as you say, there is general expectation for JVs to be integral. But then we heard that the same could apply for associates, so that line would be very inaccurate in that way. And maybe this is a good place to mention that we are in the process of conducting field work with a number of companies across the world testing these proposals, and very curious to see in this sample whether companies deem all their JVs to be integral or maybe not.
Aida, would you like to take David Bassett's question, because it just continues on the from the JVs and associates?
Oh yeah, yes, I've just seen that. Hi, David, are you with us? Okay, I'm not sure if David has been unmuted, but I will read the question. So the question is around, why is the board proposing to split equity accounted JVs and associates and not those into integral and non-integral, and not those accounted for at fair value? So, and this is quite a nuance in the proposal. So thank you, Dave, for highlighting this. So the proposals are really that integral, non-integral doesn't apply to associate joint ventures across the board, but only those accounted for using equity method. And, you know, this is for the reason of the problems that equity method has with it, in that it is a net number that you can't really successfully include in the operating profit without messing up your margin analysis. Some companies are either obliged to or have an option to account for equity accounted for associate and joint ventures at fair value, and in those circumstances the board is proposing to treat them as any other investment. And the reason for that is, so as Anne was going through proposals for financial companies such as banks, insurers, investment companies, and those multi-activity companies, you might have noted that in some circumstances entities are required to move income and expense from investments into operating if this arises in their main business activity. And this would also apply to associate and joint ventures that those investment companies carry at fair value. So for those, they could also include them in the operating if they are part of their business. This does not apply to investments accounted for using equity method, because the board felt equity method, even if close to your main business activities, it just distorts things too much and therefore should be kept below. But as I said, the board still wanted to enable those investment companies that account for their associate and JVs at fair value to include them in the operating, and therefore they are treated as any other investments and they move up in the operating in those circumstances.
Ida, we have another question from Monica. Hi, Monica. I will probably just read the question loud before Monica is unmuted. So Monica has asked, currently there is no clear guidance on presentation of certain items in P&L. For example, under IFRS 9, where to present day one gain or loss? Is it unwinding? If it was deferred, gain or loss on the recognition of certain types of financial instruments? Does the project look to provide clarity in those other standards to ensure consistency of presentation?
Thanks, Helena, and then thanks, Monica, for raising the question. And maybe this is opportunity to clarify that whilst we give example of type of things that will be classified in particular categories, the board has not generally approached this project as saying this particular income or expense goes in this category, but it's very much driven by functionality, which is why, you know, we say, for example, we expect remeasurements of investment property to go in the investing, but actually this doesn't apply in all cases, because if your main business is to invest, then those remeasurements go into the operating. And the reason I say this is similarly for instruments accounted for accordance with IFRS 9. It's their classification is driven by the underlying instrument, but then it really depends on your main business activity. So if you are a financial institution, you are quite likely to have everything in relation to that instrument feature in the operating category. If you are not financial institution, then depending on whether it is asset or liability, it would be in the investing or the financing. So it's very much driven. So is this in your main business activity? If it is, everything related to that is operating. If not, then it goes in the investing or the financing, depending on the definition.
Monica, does it answer your question?
Hi, Helena. How are you?
Good, thanks.
I guess to a degree, and I appreciate that approach, and that makes perfect sense to me. However, what I'm finding is at times there are certain components that don't quite follow this same structure and the same logic, and you know, having interest on lease accounting, for example, leases might be part of your core you know, activities, but under the leasing standard at the moment, we ask to put interest specifically as financing. So I find that certain inconsistencies where specific standards do require certain disclosures, and interest is one of those that is defined, whereas other items are not necessarily as prescribed, and that creates different presentation in practice, and also sometimes for different types of financial instruments in particular, you might have different presentation depending on whether the nature of the instrument is, for example, receivable or is a loan. So from that perspective, so is it a trading instrument or not, a result of your trading activities or not? So I would find it useful if there was further clarity to actually keep those things more consistent. Thank you.
So I'm taking this feedback on, and we can, that can form part of our submission to IASB. Aida, would you like to comment?
Just, thank Monica, and indeed we do find with there are particular transactions that maybe it's unclear, or like you said, Monica, there could be inconsistency in application, and this is really, again, I'm mentioning the fieldwork exercise. Why is it so useful to actually identify these and bottom out any risks that the board needs to address? And maybe the opportunity just to comment quickly on the leases, because you're quite right, many entities would enter into lease contracts as a part of their ongoing business, and anything related to those assets, lease assets, would indeed feature in the operating. However, lease liabilities do meet definition of financing activities or liabilities arising from financing activities. So this project is carrying on what already is in IFRS 16, that those income and expenses from lease liabilities would be classified in the financing category.
Helena, we have a question from Eric about, does this mean OCI will be abandoned? We've kept the scope narrow of the project, and we're just looking at the statement of profit and loss, and we've done very little to change other parts. So no change to OCI in terms of how it works at the moment and the concepts. There are some proposed changes to the names, the titles, the subtitles, the subtotals that we're using, but the whole concept is still in place and we haven't made changes there. I'd also like to comment on something else we get questions about, and that's EBIT and EBITDA, because EBIT and EBITDA are very commonly used subtotals now. So people ask the board, why didn't we use EBIT or EBITDA, and why didn't we make them defined terms? So as I said in my introductory remarks, the way EBIT and EBITDA are currently used now doesn't mean they're actually comparable, because entities have a free rein in how they calculate them. But in EBIT now, in the structure on on your slide 7, an EBIT could be captured in that line that we're calling profit before financing and income tax, because as long as the construction is as defined here on slide 7, and all the interest and the tax are appearing in the financing section, then that particular EBIT would be consistent across entities, so profit before financing and income tax. That could be comparable. However, for EBIT, we looked at it and we discussed it at length, but we couldn't reach a definition for EBIT that would fit in with this particular structure. And one of the real challenges for us was there's really no underlying concept for EBIT, and there's great diversity, as I say, in practice. So it isn't one of our defined terms, and that means when we come on to talk about management performance measures, it will be necessary for a reconciliation. Also, when we're talking about by function, by nature, that also has implications around EBIT. So I'll come back to that in a few moments.
Thank you, Anne. We don't have any further questions, so I suggest we move on to the next chapter, which is disaggregation. So Anne, over to you.
Right. So the second section we'd like to talk about is disaggregation. So the feedback we've heard from investors is that they're not getting the information that they need. And the various proposals in the exposure draft are about improving the way entities undertake aggregation and disaggregation. So in slide 14, you can see a series of boxes, and they're capturing what we're covering in the exposure draft. So we want to use these proposals to strengthen the requirements around the analysis of expenses by nature and by function. We want to provide some more guidance and clarity about the roles of primary financial statements and notes. There are some additional line items that are to be disclosed, including goodwill. We have proposals around unusual income and expenses, and we'll talk about those. We're putting forward some principles to help entities when they are aggregating and disaggregating, and also talking about the labelling of grouping of immaterial items. So going to slide 15. In terms of the roles of the primary financial statements and the notes, we wanted to give some guidance that would assist preparers and give more clarity. So in terms of primary financial statements, we're saying that their role is to provide structure, a structured and comparable summary, whereas the notes, the role of the notes is about providing further information, and further information that helps understanding what is in the primary financial statements. Together, the primary financial statements and the notes can help to meet the objective of financial statements. In terms of required line items, you can see that the idea of the integral and non-integral associates and joint ventures that will engage with separate line items in the statement of profit or loss, and also in the cash flow statement and in the statement of financial position. Another new required line item will be in the financing category, the income or expenses from financing activities, and in addition, a separate line item for goodwill in the statement of financial position. Looking at slide 16 now, the idea of disaggregation being used well, we thought it would be helpful to provide some guidance via some principles. So what you can see in the first grey box on the right is a statement of principles that entities will be able to use to guide them as they're doing aggregation and disaggregation. So after the process of identifying assets, liabilities, equity, income and expenses that arise from individual transactions, they can be classified into groups. And we're suggesting that classification would be based on shared characteristics, so that the line items in the primary financial statements, they share at least one characteristic. Now, this is about improving the relevance and the understandability of the information disclosed, and whether, when further information is required, that this can be provided in the notes. We're also suggesting that this category that is sometimes used, other expenses, which is a grouping of dissimilar and immaterial items, would be very helpful to have a meaningful label for this. If a meaningful label can't be achieved, well, then it'll be important in the notes to provide some information about the content of that. Going to slide 17, and this is proving to be a very important area of the proposals with lots of discussion. So as we know, under IAS 1 now, there's a requirement for an analysis of operating expenses by nature or by function. So the proposal in the exposure draft is that an entity chooses to present that analysis in the way that makes the most useful information for users. So not a free choice, but a choice between whichever presentation will be most useful for the users of the financial statements. The key thing here is that the proposals say not to mix up the by function and by nature, which is what is happening with some entities now. If the analysis is by nature on the face, there can be additional information in the notes. If the analysis is by function on the face of the statement of profit and loss, there will need to be an analysis of totally operating expenses by nature. It isn't a requirement to analyse each functional line item. It's a requirement to provide a by nature analysis of the total of operating expenses. Now, we've heard a lot of feedback from investors saying that this by nature analysis of line items is really important to them. It's what they use when they're making their models and making their predictions. And that is why we've arrived at this requirement. Now, some users would have liked a full matrix presentation where every by function was broken down into by nature, but the board, although talked about that, the board pulled back from that, deciding that that would be too costly to do that sort of presentation. So the current position is to require, if the by function presentation is made on the face, then there will be a by nature of the total operating expenses. I think this is important for some entities in Australia where they have been using a mixed presentation. And if you have been involved in a mixed presentation or indeed been involved in presenting EBITDA as one of the subtotals, it won't be possible to present EBITDA because that would be a mix of by nature and by function. If we turn to slide 18, we can see an example of that analysis by nature in the notes. So we can see all the line items and it's a breakup of the operating expenses in total. If we turn to slide 19, this is another area that has attracted a lot of interest and discussion. We know that many companies provide information to users by describing things as unusual income and unusual expenses. And investors may find this useful, but they've also given us feedback that this really lacks clarity. So we're doing a couple of things here. Firstly, defining unusual income and expenses, and we're defining this around the idea of predictive value. So unusual income and expenses are those with limited predictive value. We're saying that these are the types of income and expenses that are unlikely to arise for several future reporting periods. So the entity has a reasonable expectation that these would not be arising for several future reporting periods. They are income and expenses that are similar in type and amount. So within the disclosure requirements, the proposals are that the amount of unusual income and expenses is presented. There's a narrative description about how it arose and how it meets the definition. So in terms of the total, that would then be disaggregated for the line items that are appearing in profit or loss. And also, if we have a by function presentation, we'll need to have the total operating expenses by nature. That is within the total disclosure of unusual income and expenses. So I'd like to pause here and we'll take some questions. So we're looking for questions, comments or feedback on our proposals regarding disaggregation.
We have a question from David. So Aida, would you like to answer David's questions? David, are you on the line? So maybe
Hi, David.
Hi, how are you? Sorry,
Okay.
my typos. I've got a young child in the background, so trying to get my comments in fast.
So what is your question, David?
So I think, as Anne pointed out, in practice in both Australia and New Zealand and around the world, we seem to observe that companies use a mixed presentation. And when we actually go out and talk to preparers and users, at least for many of those, there seems to be a poor understanding of the actual distinction between nature and function. So I was wondering whether the IASB actually explored whether it was necessary to retain this distinction and whether an alternative might be to allow a mixed presentation on the face, but obviously in light of the feedback from investors that they do want information by nature, that you would then require disclosure by nature in the notes.
Thanks, Dave. And this is, as Anne says, this is a point on which we have lots of discussion, and it may be useful just to give a little background as to why the board is proposing this strengthening of requirements to make it super clear that there shall be no mixed. And often I've heard examples in outreach with investors of them finding financial statements of two companies that both present cost of sales. So cost of sales is something you would associate with functional presentation of expenses. But then they say some companies would present cost of sales, but then they would have a separate line item for depreciation, for example, whereas others would not, so they would have a fully functional presentation of cost of sales and then maybe selling expenses, research and development, and so on. And they find this very problematic because the company that hasn't allocated depreciation to cost of sales and other function, they find that they have no information to know how much of this depreciation should be in the cost of sales, and they have therefore no way of comparing the cost of sales between different companies. And this is, I think, similarly if you're using by nature presentation, but then you allocate something. So for example, if you have a cost of sale, and then if you have a staff cost as a separate thing, for example, which is by input by nature, you can argue that it's very confusing for investors, because what do they judge from that? Does it mean this staff cost is all of the staff cost, or is it staff cost excluding the staff cost that's been allocated to cost of sales? So there is a great potential for information being incomplete and even misleading potentially. So this is the reason behind the proposal. But let me just clarify, because we say no mixed approach, but actually there is exception to that, and the exception to that is what is in the list of minimum line items already in IS1, and this minimum line items such as impairment on financial instruments are required regardless of whether entity presents by nature or by function. So because minimum line items are generally by nature, then that means that even companies that present expenses by function would have a mix in a way to meet those minimum line item requirements. And maybe just to give you a little more flavor on this, given that it is a contentious topic and we are looking to feedback on this, we have received some feedback that because we have quite a lot of minimum line items in relation to financial instruments, in relation to insurance contracts, but maybe not as many in relation to tangible assets. So for example, whilst impairment of financial instrument is a minimum line item, impairment of a physical asset is not a minimum line item, but it is something that's highlighted as a potential presentation. So we have a feedback to say, why doesn't the board consider aligning those things perhaps, and then bringing some of these line items in relation to non-financial, non-insurance into the minimum line items, and therefore enabling companies to have them presented regardless of whether they do by function or by nature. So I hope this somewhat answers your question, Dave.
Yeah, thanks, Ada. I think it does also raise another question around cost of goods sold, and I'm just conscious that there's no actual definition of cost of goods sold, and maybe that's something that's worth exploring, but I'll leave that with you to think about.
And Ada, maybe why did the board think it was necessary to put those financial instruments disclosures on the face rather than in a note? So I guess that would be my question, is why they are seen as being more important than those other disclosures?
I thanks, Chris. And I mean, this, as you know, was not a decision made on this project. And I think I wouldn't necessarily say the board thought they were most important. I would say just because they were developed by the boards at different times and perhaps using somewhat different approaches, that they ended up being in this minimum list, whereas others ended up being in this, let's call it, possible list, but is not exactly treated as minimum. So perhaps if the board were to consider everything at once, the same decisions wouldn't have been made. On this project so far, the board has taken a view, look, this is a general standard, and let's not mess with the decisions the board has made in individual standards. So there wasn't even a discussion about potentially changing the status of some of these line items coming from IFRS 9 and IFRS 17, or lifting the status of some of the line items coming from the older standards. But you know, we are hearing lots of feedback on this, and depending on that feedback, I guess the board will decide whether there's a need to look at that.
Helena, I'd like to talk to Monica's question. Hi, Monica. You're asking a question about unusual items. So we do know that we've had this type of discussion, you know, how long a period, what do we mean by reasonable, and what do we mean by these several future reporting periods? So in some of our discussions, people have said they've viewed this as quite tight, saying that there are some instances like the one in your question where you're asking, what about where there's a long-term restructure or a strategic change and taken by an entity, and it comes through over 3 to 4 year period. So would that fall outside our definition? So that's going to be the judgment call of the entity and the auditor. But looking at the wording as it's sitting there, several future period, I think 3 to 4 years would be outside that. So your question is, how does the entity communicate that information then? So what we've heard from investors is they would say, stay with the narrower view of your definition. And when people have something like what you're suggesting here in this example, long-term restructure or strategic change, 3 to 4 years, they'll need to provide the additional information so that the investors can accommodate that.
So would that be allowed in the financial statements, or would that be as part of the market releases and communication with the investors? Because that's some of the challenges that we're facing, that analysts in particular, they would like to probably see a little bit more disclosures of this, what they refer to, you know, non-recurring or one-off items. And there is obviously a need in the marketplace to communicate those, to really get to the bottom of what they refer as underlying results. So when you're going through a period of restructure or strategic changes, those are very important. There's really not a, like at the moment, that the you know, requirements in the accounting standards actually forbid presenting the one-off or non-recurring items and spelling them out. So
well, they'll get a chance with the you know, they'll get a chance to highlight through the unusual income and expense over the period of, you know, the 1 to 2 years type period, and then they'll be disclosing in their other places like management commentary how that's been going. It's quite interesting that there aren't significant restructures, that then the discussion stops. We've noticed this in our work on the disclosures around mergers and acquisitions, that there can be some particularly good disclosures when it's happening, and then even though it goes on, the disclosures can stop. But that's a discussion for another day. We did have another question.
Just to quickly clarify, so in that case, would you still argue that those kind of items will be disclosed in the financials as unusual in the first year, let's say, and then because they are happening in the following period, then you would drop that disclosure from that period onward? Or would you not disclose them as unusual because you expect them to continue for 3 to 4 years from the outset?
It's going to be the judgment call of the entities and the auditors, but I think they'll take advantage of whatever's in that first year as an unusual disclosure. If it's unusual for that first year, meeting the definition, the fact that it's going to go on for 3 to 4, but they're in the particular year, the first year that you're looking at, if the entity believes it fits into the definition of unusual, well, then I expect that to see that separate disclosure.
Thank you.
So maybe, Anne, if I can just add to Monica's discussion, because this is really something we get lots of questions on, and restructuring is such a common example. And Monica, exactly the way you asked, we had questions saying, oh, you know, restructuring sometimes is taking a little bit longer, and why is that not in the definition? And just a few weeks ago, we had a discussion with a group of users who were actually quite supportive of this narrow approach to definition, because they've given me examples of companies they are following, and one company in particular was mentioned that was listed about 20 years ago, and they said in those 20 years, in every single reporting period, they have disclosed restructuring costs, and in every single reporting period, they said this is exceptional. And the users really feel fed up with this practice, because that is really not helpful to them. And this is why they are supportive of this narrow approach, recognizing that you might lose some genuine ones, like you say, where you really are doing something for a couple of reporting periods. And maybe just to clarify then how definition works, because definition is forward-looking, as Anne explained on this previous slide. And you are looking at what will, whether a similar type or amount of expense will or income will recur in several future reporting periods. So in case when you start restructuring and you know or you plan for it to go on for 3-4 years, then at the beginning it would not meet definition of unusual, because you know that similar type and amount would recur in the future reporting periods. And it's only when you get to the last reporting period where you no longer expect to have future restructuring in future periods, then it would meet definition of unusual, which can be a little bit counterintuitive with regards to how people generally think of unusual as something that hasn't happened before. But bear in mind, this is very much about forward looking and about helping investors predict future cash flows. So you can easily have a case of something that you've had for a number of periods, but because your expectation is you will no longer have it from that particular period onwards, then it meets definition of unusual. And as Anne said, there's nothing stopping companies to provide additional disclosure about things that do not meet definition of unusual. And actually, IFRS standards already require entities to disclose significant judgments made, and I would guess the judgments around what meets and what doesn't meet definition of unusual would probably fit and will be required to be disclosed as a part of that.
And just to note, there are some examples in the implementation guidance and also in the basis for conclusions, so it's worth having a look at those aspects of the ED as well.
Thanks, Chris. And I think are we moving on to Martin's question, Helena, or did you have something else?
Please. No, yes, please.
Okay. Hi, Martin. So you had another question about unusual, and if you're with us, maybe.
Yes. Yeah. Can you hear me?
Yes.
Yep. Thank you. So my question, I'm thinking of two companies in particular. Is unusual, I know there's a kind of forward-looking definition, but what happens if you're a company where an item is unusual in your business activities but happens frequently but not predictably? So you are a business, you're a packaging company that will have major property sales sort of every other year. Is that an unusual item, or is it Is it by nature of business activity, by the type of the expense, or is it a pure management judgment?
It's it's not pure management judgment just because there is a proposed definition, the exposure draft, and guidance around that. I think in your example, you say, you can quite see, because this is something that is not your business and it's potentially one-off, therefore you might conclude it is unusual. But I think when you say a company that does infrequent property sales, I think it becomes then a question of judgment, because if you are not doing this in every reporting period, but you might still not be able to make a judgment that similar sale or similar gain or loss from sale will not arise in several future reporting periods, and therefore you would still not meet the definition of unusual. And this is where the several future reporting periods is important, because the board didn't want to say 1 or 2 and kind of say companies, okay, because I'm not going to do this for 2 years, I will do it in 3 years' time. Again, I will classify it as unusual because again, if something is kind of regular occurrence, even if not at every reporting period, then it's a different information that users need than something that is genuinely an income or expense that management doesn't think will happen again. So in summary, you can have a link, but doesn't necessarily mean if something is not your main business activity, it meets the definition of unusual. I hope this helps somewhat, Martin.
It does, thank you.
And I think also there's some good disclosures, Martin, around how you've come to those unusual decisions, because they would become significant estimates and judgments.
Yep.
And we have a couple of minutes, so before we move to another section. So I just wanted to ask one more question that we heard already before and yesterday, and it related to unusual items and current coronavirus environment. So people were asking whether actually this environment which we have now is something that would actually give rise those unusual items. So for example, they said that normal revenue and expenses would be actually affected by the, by the current situation, but on the other hand, they would have some subsidy, or they may have some subsidy from government. So how this would all fit within the unusual items line. So maybe would you like to clarify on this?
Yeah, thanks, Helena. Yes, so we can expect that there are going to be some events that we weren't predicting, analysts weren't predicting 6 months ago. So there are going to be some items of income and expense. And following these proposals, people are going to have to look at them and just think, have we got this, looking at this idea of several future reporting periods. So Aida touched on if it's going to go over 4 periods, then that we wouldn't expect to see that disclosed in year 1 as an unusual item. So people are going to look at these coronavirus related income and expenses. And I think that unusual income, the highlighting that will go on by classifying them as unusual income and expenses will be very helpful for investors, because it'll provide them with more information. And one would hope that some entities would see them as short-term and fitting in with the definition, in which case they'll provide the disclosures. And I think that that would be very useful for people.
Thank you, Anne. And I think considering the time, we could move to another section.
Thanks, Helena. We're going to go now and talk about management performance measures, which is under item 3, our third area, before we touch briefly on cash flows. So in terms of management performance measures, or the things that some people identify as non-GAAP, the issue here that's been raised with us is that for investors, they do find this information useful. And many companies do provide the information, not everyone, but many companies make use of this. So the issues pointed out to us is the fact that some of these management performance measures are not transparent, the disclosures are difficult to find, and indeed, for some entities, they change between period to period. So investors would be interested in the information, particularly if it could be presented in a more transparent and disciplined way. So we know from looking at company practice that there are a range of management performance measures that are currently presented. There might be adjustments to profit or loss. There might be adjustments on operating profit or EBIT or EBITDA. In Australia, reconciliations are provided. It's a requirement of ASIC and RG 230 that reconciliations are provided. What we see, though, when we look more broadly, not all entities are in countries where reconciliations are required, or indeed the requirement is not enforced. So entities are not providing reconciliations. And in many reconciliations, the tax effects are not specific enough. And then for investors, as they look at the adjusting items, when they want to adjust for the exclusions that have been presented, they need to know tax effects as well. So they're in our proposals. If we go to slide 23, you can see our definition for management performance measures. So we aren't specifying how companies should prepare their management performance measures. What we're doing is we're saying that management performance measures are the subtotals that are being presented, but they're outside the financial statements. They are complementary to the totals and subtotals of IFRS standards, and they communicate a management's view of an entity's performance. So we aren't defining specifically what is a management performance measure for a particular entity, because we can't do that. There's so many entities and so many different versions of what management would like to present. However, we do have constraints around it, and they are constrained. The disclosure of these management performance measures is still constrained by the idea of faithful representation. These measures must faithfully represent what they purport to represent. So the proposals include disclosures of the amount of the management performance measure, some narrative description of why the entity thinks that this is useful, what it is they're trying to communicate through the management performance measure. The reconciliation requirements are between the management performance measure and the most directly comparable subtotal or total. So through this proposal in the ED, we have additional subtotals now. So the MPM disclosures can be reconciled into those additional subtotals. And as I've mentioned, income tax effects and effects for non-controlling interests. And these disclosures will be located in the notes to the financial statements. If we take a look at slide 24, we can see where these management performance measures, the ones we're talking about in this exposure draft, where they fit in terms of the entire landscape of performance measures. So on the left-hand side in the grey box, non-financial performance measures. We know there are many provided by companies in various places. Things like a customer satisfaction score. These are under the heading of non-financial, and we're not referring to those when we talk about MPMs. There are now several IFRS specified measures, profit and loss, operating profit. Indeed, companies can present operating profit before depreciation and amortization. And those IFRS specified totals could be related to MPMs, such as adjusted profit or loss, adjusted operating profit, adjusted EBITDA, and they're shown in the dark green box there. There are other measures that are not subtotals of income and expense, and they are not sitting within our concept of management performance measures. So things like free cash flow and also the ratios, return on equity and all sorts of ratios. The net debt subtotal is not falling within MPMs. So we'd like to open for questions now. Any questions or comments or feedback on the proposals in relation to management performance measures?
As we are waiting for the questions, and can I ask one question? So does it mean that all non-GAAP measures would be MPMs?
No, Helena, if we look at slide 24, what we're trying to show there is that we're very specific about what we mean by MPM. So people can create all sorts of non-GAAP measures, and the non-GAAP measures could be non-financial measures, or they could be measures that involve other sorts of combination of a financial number and a non-financial number, or other measures that entities create and want to report on that are important to them. But there are many measures, but they won't be management performance measures.
Thank you. Aida, can I ask one more question? We also heard a question on whether the MPMs should actually capture the underlying cash earnings.
Indeed, and again, this is an area of feedback that we are getting a lot, not specifically with cash earnings perhaps, but general question as to why is the scope of MPMs limited to subtotals of income and expense, and why is it not looking broader? And the board really, I think, as Annex explained, the MPMs are very much linked to what the board is doing in statement of profit or loss, and the new subtotals proposed there, which would act as a new anchor points for the reconciliations. So it's a very much complement to information that is provided there. I think when you start talking about underlying cash earnings and measures that are more akin to the cash flow measures, then it becomes a question of judgment. So when we look back at the definition of management performance measures, so being income and expense subtotals and being complementary to IFRS specified subtotals, it becomes a judgment as to whether actually those more cash-based measures would meet that criteria or that definition, or whether this is actually a different measure altogether. And again, this is one of those areas where I'm looking to see what companies that apply the proposals in our fieldwork as a part of this exercise, what measures they do identify that they think meet a definition of management performance measure, and then we will take that feedback to the board for further adjustments as needed. Maybe just to mention, now we're talking about this. So on one hand, we had calls for broader scope of management performance measure to include measures that are more like, free cash flows and the like, and also maybe some of the ratios, return on capital employed, and others very commonly used measures. But then on the other hand, we had calls to not actually do anything about this and saying, well, there's no room for non-IFRS numbers in IFRS financial statements. And the users are generally very supportive of these proposals because they feel that the value of the transparency of the discipline of this assurance that they will get with these being audited is really valuable to them. But still, given some controversy around this, the board felt limiting the scope for now and kind of complementing the work it's doing on the statement of profit or loss is maybe good approach to take, and then potentially in future, if there is a demand to expand, then look into expanding that. So I think we have a question from Dave now.
Yeah, hi.
Is that right? Hi, yes, we can hear you, Dave.
Okay, cool. Yeah, my question was just around the requirements or the restrictions that you an MPM would only be, if I can use a performance measure, that would faithfully represent management's performance, or wording to that extent. I don't have the ED in front of me, but I was wondering what was the thinking behind this restriction, because I know when we've spoken to a lot of auditors, they've flagged that this could potentially cause some interesting conversations with their clients. And some had views that actually under our regulatory disclosure requirements for alternative performance measures, entities may have assessed that a performance measure might not be faithfully representative and therefore not be subject to the IASB's disclosure requirements, but would end up having to disclose some MPMs that do meet the requirements in the financial statements and others outside.
Thanks, Dave. And can I just clarify that, does your regulation have a prohibition of misleading measures, or is misleading not mentioned either?
It does talk about misleading. So I think, if I remember correctly, the proposals include both faithful representation and shall not be misleading. Is that correct?
Mm-hmm. So, well, we refer to faithful representation in the exposure draft because this is the concept that we have from the conceptual framework, and it's also something that is already present in IS 1, but maybe just give you a bit of background on this. So the faithful representation as a criteria is something that is already in IS1 as a generally applicable concept to all information presented or disclosed in the financial statement. So, you know, it should faithfully represent what it purports to represent. So it's not something specifically singled out for MPMs. However, so it would apply regardless, as it applies to everything. But the board has proposed to emphasize this as a part of MPM drafting and the guidance as a response to concern that this could mean that misleading measures could make their way into the financial statements, and it is just as an assurance. So I don't think it was not intended as additional kind of criteria in relation to the measures that are already subject to regulatory guidance in jurisdictions with good regulation on this, because it's just the other side of misleading, and lots of regulatory guidance, and I think you mentioned yours as well, already have a prohibition of misleading measures, and you know, measure that faithfully represents what it purports to represent is not misleading. So it was not intended as this additional step. And maybe that, given that you mentioned auditors, it's worth highlighting something, because I did notice talking to auditors, there is a little bit of maybe misconception around this, in that some think this means that they have to judge whether the measure is useful or not, and this is not at all what the intention was, or whether the measure is relevant, because it wouldn't be reasonable to expect auditors to make assurance and such judgments, but rather it is really just meant as a complement to give assurance to actually investors, to regulators, that you know, bringing these measures in does not, you know, that we manage the risk that misleading measures could be in the financial statements. Having said that, still management performance measures are defined by management, as the name says. So management can define how this measure is calculated, or would define how it's calculated, and faithful representation is there only so it doesn't mislead in a way that it describes this measure. So if the measure excludes most of its operating expenses, I think it will be very misleading to label it and describe it as representing operations, for example. So this is the kind of thing that the proposals are there to manage. I hope this helps, Dave.
Yeah. Yeah, I think the misunderstanding that you've said is sort of hit the nail on the head, and I think potentially that's some of the drafting in the ED, because a lot of people say, well, if you look to IFRS 8 segment reporting, there's not a similar paragraph in there, and if we view that MPMs are really providing management's view of the world, if I can describe it crudely like that, when we look at the wording in the standard, it sort of talks about faithful represent aspects of the financial performance of the entity to users of the financial statement. So I potentially think that's where maybe some of the concerns are coming from.
Okay, thanks, Dave. Yeah, certainly keep an eye on that one.
We have time. Yeah, go ahead.
Can I take that question from Marvin Wee, please? And then I'll speak to Eric's question. Marvin, are you unmuted?
Yes, I am, Anne. Can you hear?
Hi, Marvin. You've asked whether MPMs can be presented on the face, and it's a good question because it often comes up. It's very jurisdictional. Some countries or jurisdictions don't permit, their regulators don't permit the non-GAAP reporting on the face, whereas other entities, other countries or jurisdictions, it positively thrives on the face. So under our proposals, it would be possible for some management performance measures to appear on the face, just so long as they fit in with the structure. So if we think about that structure we saw back on slide 7, no need to go there, James, but if we think about the structure we saw on slide 7, it would be possible to have additional subtotal in there. IAS1 permits additional relevant subtotals. So you could have an additional subtotal in there, which was effectively a management performance measure. If you were presenting by nature, you could have a subtotal before a particular line item that you wanted to highlight to investors. So it is possible. It's not prevented, but we do believe that for many, many entities now, with the way they present their management performance measures or the way they present their non-GAAP, it would not fit within our structure. So we think that for many, many entities, the disclosures will be in the notes and they won't be on the face.
Right. Okay. I just think in terms of not allowing on the face, well, or allowing it on the face actually encourages transparency in terms of, you know, because in the notes, it seems to be, to me, that it's sort of partially hidden. But if it's on the face, then the companies would need to actually refer to a reconciliation as well, somewhat. Yeah.
So it'll be interesting to see how many entities, particularly the ones, say, for example, in the UK, where they're used to putting it on the face now, how they can accommodate that within the new structure.
Sure. Thank you. Thanks,
Marvin. Eric, you've asked us about management performance measures for the not-for-profit entities. So would this be an opportunity for them to communicate qualitative measures? I think with our proposals in the ED, we are thinking about quantitative measures, and we are thinking, as Aida's pointed out, about the adjustments to these subtotals. So they are very much IFRS numbers. With the whole thing is based on IFRS numbers, and some people choose to present a subtotal and then adjust to highlight certain aspects. So I think our proposals are around quantitative measures. So I didn't see them helping not-for-profit entities with their disclosures, but I might just hand over to James. I think he may be able to give some insight on this.
Yeah, thank you, Anne. Yeah, I would echo your comments that I don't think that the current proposals from the IASB would necessarily address those issues. Of course, though, the IASB does have its not-for-profit standard setting framework where it can certainly look at a solution such as this to fit the needs of not-for-profit users. And I have no doubt the board will think through options such as this in its not-for-profit financial reporting framework project, as well as its service performance reporting framework. So we'll definitely do that. Of course, or I expect the board would do that. Of course, some of the challenges that I foresee might arise applying these for that purpose in the not-for-profit space would be to what reconciliation might be performed. Obviously, some of the disclosures could become irrelevant, such as the tax effect and the non-controlling interest effect, as well as some auditing challenges that could come about. But I think it's a good comment, and we'll definitely take that forward from the not-for-profit perspective domestically.
Thanks, James. I'd like to return to the slide deck and just a couple of comments on cash flow statement. So if we look at slide 27, as I've said today, that the main focus of the ED has been the statement of profit or loss. There are some changes proposed for IAS 7, the statement of cash flows. The first important proposal is that the indirect reconciliation will start with the operating profit subtotal. We're proposing that to get rid of the diversity that is currently there. Now, I know this is not relevant for a lot of entities in Australia because these entities use the direct method, but in other jurisdictions, many entities use indirect method, and there is a diversity in the starting point. So we are proposing that operating profit would be the starting point. The second important aspect for the statement of cash flows is removing optionality. So the ED proposes to remove options in relation to dividends paid and received and interest paid and received. So slide 27 shows you IAS 7 classification where the choice is there, and the proposed approach would see interest received, dividends received in investing, interest paid and dividend paid in financing. The other aspect of the proposal recognises that for entities in the financial sector, they're going to approach this differently, and we would expect that their classification would be based on where the related income and expenses are appearing within the statement of profit and loss. So if we just turn to slide 28, that gives us an illustration. And what we can see there is, for example, dividends paid in the dark green down at the bottom. We can also see the line items coming through for the integral and non-integral joint ventures and associates. Right, we're going to open for any questions and comments or feedback you might have about the proposals in relation to the cash flow statements.
While we are waiting for the questions relating to cash flow, I noted that we got one more question from Lisa relating to MPM. Aida, would you like to answer the question?
Sure, Helena and Lisa, are you with us?
Yes, I am. I don't know if you can hear me.
Yes, we can hear you, Lisa. So would you like to share your question with everyone?
Yes, it was just whether the IASB, when they were looking at the disclosures relating to MPMs, whether they discussed how an MPM is used internally by management. We've kind of had a few questions around that.
Thanks, Lisa. And so the management performance measures are really about communicating performance to investors, and the measures that, they're meant to be measures that do that. They are not, so the philosophy behind the proposals is not, like philosophy behind something like IFRS 8, when you look at how management manages its business and the measures it uses to do that. So it wasn't a natural fit with what the management proposals for the MPMs are about, and therefore it is not proposed in the exposure draft. But having said that, we have heard feedback that it would be useful to know whether any, and if so, which of the measures are used for things, for example, like management compensation and so on. I don't know if this is a specific point you've heard as well, or is it more broader than that?
Yes, we have heard that point, and also it is something that is actually in our regulator requirements, so in our FMA requirements. So I was just interested to see whether it had been discussed as being included.
Yeah, I have a sense that it will be discussed in redeliberations, Lisa.
Thank you.
We don't have any further question on the cash flow, and I will ask you to move to another slide and explain the structure of the ET.
Thanks, Helena. So slide 30 explains how we're proposing to make the new IFRS standard. We'll have the proposed new presentation and disclosure requirements in the new standard, and we'll bring forward parts that are relevant from IAS 1. We are making limited changes to what we're bringing forward. We are not intending to change those requirements, and so it's a very light touch in terms of any wording changes, very limited. We are presenting the new material in a new standard along with whatever we need to have accompanying it out of IAS 1. The other requirements in IAS 1 will go to IAS 8 or IFRS 7, and we will withdraw IAS 1. There will be amendments into other standards. IAS 7 we've talked about. IFRS 12 with the associates and joint ventures will have some amendments related to integral. There will be changes to IAS 33 because, as you may recall, in the earnings per share standard, there is adjusted earnings per share. So we've got some requirements in relation to what adjusted earnings means. Also some requirements to make some changes into IAS 34 as well. Slide 31 shows you where all our materials are located, and you can access all those on the website. You can also see a video where Hans Hugovost was introducing the exposure draft. I'll now hand back to Helena and James to talk about responding to the IASB.
Thanks, and so I would like to encourage everyone to actually provide us with the feedback on these proposals. It doesn't need to be a formal submission letter. We welcome any feedback. So even if you give us a call or if you shoot us an email with the bullet points, because we understand that everyone is busy, especially in the current environment. So it can be very informal email with the bullet points, what you find difficult or what you would like to see in the proposal, or if you find any issues with what has been proposed. We will welcome that feedback and will include it into IASB submission to IASB. So please do. We have at this slide we are looking at, we have some additional questions that we would like to get feedback on. So not all of them are actually included in the Australian version of the exposure draft, but these slides, as I mentioned at the beginning, these slides will be published on our website. So we would really like to know your opinion on the questions that we asked. And James, can you move to the slide where we show all, yes, all the addresses, like all the options how you can provide feedback to us. Either you can email it us, or you can submit it on the website, or reach to us via LinkedIn or Twitter. We will welcome any feedback. So I would like to ask whether anyone else has any questions, because we have about 5 minutes left. So no question is coming in.
And maybe
so,
Helena, whilst we are waiting for questions, just as you had that slide up with your contact details, maybe I can use the opportunity also to encourage participants to use those contact details in case they want to participate, or in the case you want to participate in our fieldwork exercise. So as I mentioned, we have begun this exercise with a number of companies, but we still have scope. I don't think we have Australian companies as of now participating. So if some of you are potentially interested, even if you haven't made a decision but you just want to explore it, please get in touch with Helena and James, and we can share more details with you and hopefully work together on this.
Thank you, Aida. As we have a few minutes left, I would like to ask James to actually do or comment on the high-level comparison of ASIC RG230 and MPMS measures that we have previously done. James,
thanks, Helena. Yeah, just to cover off, so as Helena mentioned, one of our specific questions is in the Australian exposure draft is any feedback on any inconsistencies or otherwise between ASIC's Regulatory Guide 230 and these proposals. So that Regulatory Guide, for those that might not have seen it very closely, actually prescribes some requirements for entities lodging financial statements with ASIC for how to disclose or what information needs to be provided where non-IFRS financial information is used. So we've also done a little bit of a high-level comparison, and we're working closely with ASIC on that. So some of the similarities that we have identified is that there would be still a reconciliation required between both of those documents, as well as explanation as to why the measures are useful, and there's requirements for those measures to not be misleading and to be consistent between periods. However, some of the differences that we are still assessing and keen to get feedback on is the scope of the two sets of proposals. For example, the IASB's proposals focus on subtotals of revenue and expenses, whereas RG230 is potentially broader, referring to non-IFRS information. And the ED also has some broader requirements, such as requiring disclosure in the financial statements, which would lead to audit. But it also doesn't cover some of the issues that ASIC's regulatory guide would address, such as pro forma information. So we'll continue working closely with ASIC on that. Just to close off, I think we do have some representatives from ASIC on the line, so I do welcome you to to add anything if you'd like, Kerry-Ann.
Hi James, yes, thank you. We're very happy to be working with the IASB on this, given the crossover between these proposals and ASIC's Regulatory Guide 230. So as James has already mentioned, there are a number of similarities in terms of how the proposals, how the information would be presented in terms of requiring reconciliations and the like. But the notable difference is, I guess, it would be a difference in current practice. Some of the comments that were made previously about, I think Aida mentioned the investor view about no room for non-IFRS numbers in the IFRS financial statements, and some comments about the misleading as well. So at the moment, we are one of those jurisdictions where in practice, we're not seeing the MPMs in the financial statements. They're not completely prohibited, but they do have to pass the true and fair test in accordance with the Corporations Act. So it would be a difference in terms of bringing some of these measures in to the financial statements, albeit to mostly to the notes to the financial statements. So that's a significant difference. And as James mentioned as well, the scope as well, obviously the regulatory guide covers all non-IFRS financial information and covers documents, not just the financial statements and notes, but also things like the director's report, the OFR, analyst, investor presentations, market announcements, that kind of thing as well. So we'd echo the comments that please give feedback, particularly on those aspects, any significant inconsistencies or issues that would arise in practice with these proposals compared to what we currently have under RG 230. So thank you for the opportunity, and please do give your feedback.
Thank you. We had one more question from David. Aida, would you like to answer the last questions and then we will do a wrap up?
Thanks, Helena. And Dave, you've asked us about possible deferral of the comment period in light of what's going on and the coronavirus. So you might have seen the IASB has issued a press release a couple of days ago announcing a review of various deadlines, including the comment periods. So they will have a discussion. So we will have a discussion with the board at next board meeting in April, when they will make a decision about this deferral.
Thank you, Aida. So it's 5 o'clock, so I would like to thank everyone for participation, and thanks Aida, James, Chris, and Anne for the presentation. Anne, would you like to say a few words?
Helena, thanks very much. Thank you, everybody, for joining in on this presentation this morning, this afternoon, and thank you so much for your comments. So we will be following up with the information that you've given us. As Helena said at the beginning, we have recorded this and we'll be able to take that information back for Aida and her team. And we really appreciate your time and your comments as we tease out some of the elements of the proposals and hopefully modify them and make them better. So thanks very much, everyone. Good afternoon.
So I think we can say goodbye to everyone, and thanks. James, I will ask you to close the session. Thank you.
Thanks, everyone.
Bye.
Thanks.
Bye.
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 Bye-bye.